Hello and good afternoon. Thanks for joining today's Market Color webinar. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any investment results or investment returns based on the information that you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any questions or follow-up after listening to this webinar, please feel free to reach out to Jordi and/or the marketing team. Weiss would love to hear from you. A replay of this webinar will also be available on our website and the Weiss YouTube channel later today. And with that, Jordi, the floor is yours.
Hi, everyone. Couple things really to go through. After we've now had the Fed got some information from them yesterday, and we've had more data come out. I think we're at an important inflection point, and I just kind of want to take you through some slides and kind of build the story, but remind everyone that it's almost a year ago today was the bottom in the market. And we've been doing these webinars for a long time, but especially during the last year. And a lot of the themes that we've tried to highlight, particularly regarding inflation and the market being stronger, all of that now is a year in play. And as I go through some of these charts, I want you to think about the fact that the market is never as easy as what's been kind of looking at the last year to now in terms of some of the trends, which have been very strong. And I think the market's at an important inflection point. So I just wanted to kind of go through things. I think we are going to have a different marketplace from here. I briefly started to show some of these last time, but I'm going to try to go through these charts. And like I've said in the past, if anyone wants to reach out and have a longer conversation, but the risk reward in the market and in particular trends, at least for the next quarter, I think has shifted. And I'll try and give you guys a kind of a story here through pictures of why that's the case. The first one, let's just start off with some of the data for this month that's come out since the last webinar. The first few are going to be based on the Small Business Optimism Index, and in particular the pricing plans. I just want to highlight, this goes back to 1990. The inflation component is still a major story inside the data. And the Fed has acknowledged the fact that they expect both growth, inflation to be higher and the unemployment rate down. And that's fine. As I go through this, I'll talk about why I think people involved in the markets should be listening, but should not be thinking about rates staying low as the positive that it's been for the past year. And that's really what set the bottom, was the fact that the Fed came to the rescue. We have a very different situation in the market as we're further ahead in the economic cycle. Here again is the prices. This time it's overlaid with the University of Michigan inflation expectations. That's the white line. So again, we should be seeing inflation go higher if we don't see a change, or at least expectations if we don't see a change in the data. You'll see the actual CPI go higher. This again, small business prices plans. This is the CPI. As I've said in the past, I expect us to see headline inflation get up near the 5 to 6% level, just based on the history of charts, but also because of the bottlenecks that continue to be out there. This is the small business optimism pricing versus the PCE core. And again, this level approximation kind of in this area is in the 2.5 place. The Fed has kind of guided expectations there. So the risk again would be that it actually goes higher, not sits there. And this is the prices plan from the small business optimism versus 5-year break-evens and tips. So the market is definitely there in terms of knowing, or in their mind seeing where inflation's going. The question is, we have this unique situation where we've just handed out checks, we have a synchronized reopening, and the weather is about to turn after a year and change of people saving money. So the question is, over the course of the next quarter, will growth surprise more? And how much pressure will that put on a market and a Fed in terms of whether that is a good thing or a bad thing? And that's kind of the point that I want to go through. I've heard most people view that if the Fed stays on hold, then everything will stay the same way. Markets are never that easy. If the Fed stays on hold, there's a different story that could play out. And that's what I'm going to try and take you through. This is data from today. This is the new orders component of the Philly Fed. This goes back to 1981, so we have the highest level going back 40 years. Also within that report today was the prices paid. Same story, highest report going back 40 years. And then the delivery times, and this is one that I brought up last year as a problem. This is the 5-month average of the delivery times inside the Philly Fed. The 5-month average is up here. This goes all the way back to the 70s. So we are at record levels. The bottlenecks are still there. And what I want to highlight is right now this level, the current level today was 29. So the 5-month average is here. The 1-month average is still going up. So we haven't even seen this come back in yet. And that is one of the issues, that we're about to get a surge in demand and we already have bottlenecks. So I don't know how people can feel comfortable on the inflation side. This is a 5-month average of the PPI versus the CPI. So we haven't seen it come through yet, but the PPI 5-month is all the way up here versus the 5-month CPI. So I think you're going to see a change in the inflation data, not just on the year-over-year basis, but I think the risk here is that it's going to be higher. Now, the Fed has told you we're not going to raise rates, and I think that we should take them certainly at face value, especially over the course of the rest of the year. It would be surprising for them to see them change on moving rates. The issue is people view that and think that they can just sit in the same positions they've had on for the last year, which have been sensitive to lower rates. What I want to highlight is the danger of where we are and how looking at this. And what this chart is the unemployment rate. And this is where I think the risk is for at least the mindset of where we'll be in June or July. And that's my guess, is that by June or July, we will see a significantly lower unemployment rate, and probably what they expect by the end of the year, much sooner. And the question is, how will we respond if we're seeing wage pressure at the same time with the unemployment rate back near pre-COVID levels? And the difference between what we did after the great financial crisis. So the great financial crisis, we got up to 10%. This line here is when the Fed started warning about tapering. This was in May of 2013, and the unemployment rate was 7.5%. This is when the first first tightening was, and we remember the market went through a disruption in the beginning of 16. That was at 5%. I'm fully expecting, based on some charts I'll show you, that we're going to see the unemployment rate in the summertime somewhere closer to 4% rather than sitting at the 6.2, but certainly lower than here. And we're talking about not doing anything right now. So maybe the tapering conversation starts this year, but I would not be complacent on the fact that we have a different situation and the economy is much stronger and we have much more behind it. I just want to bring inflation, 2-year inflation expectations into it too. We were about at 1.5% when the tapering side came in. And then we were at 50 basis points back in 15 when we started hiking. Right now, 2-year inflation expectations are up at 2.7%. And like I said, I expect those to go higher. So the pressure is going to intensify on this decision to keep rates in check, and really to guide the market that they should just trust them. This is just a chart of the state unemployment rates versus the national average. And the only thing I wanted to highlight here for the reopening, these 5 lines here are Massachusetts, Illinois, New Jersey, New York, and California. So the average of these is about 8.5% unemployment rate. The national average is 6.2. The reason the national is down here is because this is Florida, Arkansas, Alabama. The states that are reopened have already seen their unemployment rate go back close to where we are. That's why once these states reopen, I would imagine that we're underestimating the amount of job creation and how quickly the unemployment rate will go back down towards where it was before COVID. These are just some other charts to highlight it. This is the JOLTS number, which came out this week. Back to here, you can look at JOLTS all the way back to 2001 and the relationship it's had with the total amount of people employed in the country. So this here is suggesting we're going to go back up. If you look back again after the great financial crisis peak and you go back, these things basically broke out around the same time period in terms of taking out the prior high. It was almost exact. So I would expect that we're going to see the total people employed to come back up to here. That's probably not going to happen as quick, but you're talking right now about 7 million jobs between the gap here and there. You do the math, you go through the unemployment rate, we're going to have a significantly lower unemployment rate if these things are indicative of it. And then one more, most of the jobs in this country are on the small business side. The white line here is the small business optimism employed number. We made an all-time high. So this jumped back up. This is the unemployment rate inverted. So again, another thing suggesting that we're going to see the unemployment rate come back up here very quickly, and probably much quicker than what the Fed had anticipated. Now I want to kind of take you through the forecast, because they did give us kind of the estimations for this year of around 6%. So far, just to make sure that people see it, we didn't see a change in estimates for 2021 GDP at the consensus level until February 11th. That is when we saw a change in rates, actually February 12th, the exact point, and we've seen them go higher. I expect this to continue to go higher, but this has had a huge impact. So when you're thinking about forgetting the Fed and just thinking about what the market's doing, here is the 12th contract of Eurodollar futures inverted to move with the forecast for GDP for 2021. So as estimates are going higher right now, we are still seeing the rates be correlated with it. At the same time, I mentioned this last time, most forecasts now are moving up towards the 8% real GDP level. When you add the inflation in, you're talking about nominal GDP of at least 10%. This goes back to 1987. This line here is rates. So we're still all the way down here. And if we're going to get 10% plus nominal this year, and then you take the forecast for next year, this is about the average of the 2 years. And historically, that's been an interest 10-year rate of about 8%. I obviously don't think we're going that high, but the point of this is the Fed is saying they don't care where 10-year rates go. And I think you should expect that this can get more disorderly just based on the fact that the growth numbers are continuing to go, and we're seeing people need to move things. There's other assets which are saying the same thing and saying that rates have to play catch up. This is the relationship of copper to gold, which historically has been a forecast of where rates should be. We're all the way back here. 10-year rates are lagging behind. This is equivalent to about 2.3% for 10-year rates. With inside the equity market, we have a bigger disconnect going on. This is the quality factor. So good balance sheets versus bad balance sheets or junk. So obviously forecast here that rates are going to come back to significantly lower. I'm not going to get into the forecast in there. Let's just say that the equity market from a factor basis is saying that rates should be higher. You have a similar story coming from the cyclicals in defense, which are all the way back up here. Last time we were on this ratio, you can see that 10-year yields were up closer to 3. So somewhere between 2.5 to 3 in that area is kind of where the assets on a lot of the things I look at are forecasting. As I said, we should expect the unemployment rate to go lower. We should expect inflation to be higher. And all this is doing is creating pressure. Now, one of the places that we've seen continuous movements with it is on growth versus value. So this is inverted. So this will be pure value over pure growth overlaid with 10-year yields. So the equity market is going through this continued rotation. And since 10-year yields seem to be going higher, you should expect to see more of this. Given this had been such a long-term trend, this is causing losses for certain strategies, certainly underperformance. There would be more losses if the market went down, and that's what I'm going to start to get into. This here is the 1 week rate of change for pure growth versus pure value. You can see that last week was the worst week on record, going back to 2001. At the same time, when you look at the last 10 weeks, this is where we are in this. You have to go all the way back to the dot-com bubble to see something worse. And if you go back and look, this persisted for some time in terms of the losses. So growth versus value is in the stage of a rotation, and it, based on all the factors that I'm showing you, is going to continue as long as rates are going to continue to move higher. And the Fed has told you yesterday, we're fine with rates going higher until financial conditions change. This again is pure growth versus value versus GDP. So again, as long as the GDP estimates keep going higher, I think you're going to continue to see pressure on growth versus value. And just again to highlight that the majority of the positioning in the market is still in growth to some degree. This is Fidelity Magellan relative to the S&P is the white line. The orange line is TLTs, or the long-term part of the Treasury market. So again, there's a correlation that continues between this, and this rotation is leading to more and more people that are needing to rotate. The place where this is starting to become an issue, and where I want the conversation to shift, I've talked about the fact that IG, or the investment grade return for the year, already this year, we have the worst year going back 22 years for performance. This is quarterly, and the reason I bring up quarterly is because we're going to start getting quarterly statements up for the bond portion. And so for people that have any amount of money in the credit markets right now, this is only through yesterday at down 6.11%. As we speak today, investment grade is down another 70 basis points to 1%. So that would put us down here. This is quarter to date. We still have more time. The only time it was worse was in the Lehman Brothers quarter back in 08. The reason that that's important, as I bring up the next chart, is all of the losses so far have occurred without spreads widening. So in 2008, this quarter here, the majority of the losses, all of the losses, were from spread widening. We have not seen credit spreads widen yet. And this is where this becomes an important part of the story, because it is starting to happen that the pressure to me, which is going to filter through to other assets, is going to come through credit spreads. Not because the economy is at risk, which would generally go, but because there's another part that people are missing. And this is the part of the market that I think will be the surprise. And this is on the part of not knowing where rates are going to be, or in market terms, the volatility of rates. So what we have right here is the vol of the rates market, which is going higher, overlaid with those yield spreads or the investment grade spreads. So last year, obviously, you had volatility go up on the treasury, on the interest rate side. You had spreads widening. Right now, you have vol going higher. You don't have spreads widening yet. So as I mentioned in the last one, we did not see any yield increases on the investment grade market or the mortgage market until starting on February 12th as we ratcheted up GDP. I expect now that all these correlations are in place that at some point here we're going to see a shift, and you're going to start to see spread widening because rate volatility is getting higher. And I suspect that this is going to cause some more liquidations in bond funds, which will lead to some RV credit implications. So I think the vol side or the tight spreads that are out there are going to have to widen to go through the risk that is in the treasury market. This is the CDX market, just highlighting as well that historically, when you see bond vol going higher or rates vol going higher, you see a move to CDX. That has not occurred yet. This is a critical function of what I expect to have happen over the course of the next quarter as the data is coming out and rates are going higher. From the equity market perspective, I highlighted this point in time. This was February 12th. This is when we saw a change in the markets. This has a variety of different things. The green one here is the growth side, the long side of growth relative to the S&P. This is the expensive names here. And then this is beta. All of those kind of peaked right there and have gone lower. The ones that had gone higher are now starting to show up. This is the contagion showing up for me. So if you noticed here, since this day, we started seeing these move together, where from this point here, these were going higher, these were going lower. This is the way I look for contagion, because these trades up here are crowded. These are cyclicals versus defense. And this right here is the junk side of quality, which had been outperforming significantly. And these are all dates since the election. So this all filters into a trade which was regarding reflation post the election. We're starting to see contagion, which would suggest to me that we're starting to see some unwinds. And that's what I'm expecting, is a deleveraging situation to occur. Some other places where it just started, again, February 12th, these things kept going higher. This is the white line here is trend following index. That has continued higher. This will be down tomorrow because of these lines. This is commodities in terms of this line, and then this line here is crude, which is having a big down day today. So where we are starting to see groups which were immune for the last month are starting to get hurt as rates move higher. The reason I talk about the contagion side, and this is important, right now, if you go to any of the prime brokers and you get the data on where positioning is on a gross basis or a net basis, the hedge fund community is in the 95th to 100th percentile of both gross and net over the last 10 years. This chart here is probably the most important just to think about. I highlighted this. This is the hedge fund returns. Now, this is not equities, this is global. So this is everything, credit, converts, everything along those lines. This is the one I look for when I think there's a risk of deleveraging. This point here is that we have been above, this is the 50-day rate of change. We've been above the zero line now for over 207 days. This will be day 209 today. There's only 3 times going back to 2003 that we've been above for that long. So I always have this belief that when there's not a correction in something, and you can see the Sharpe ratio here, there needs to be a correction at some point. These are the 3 times that we went longer than this current time period. And you can see here, this occurred in 2004. We ended up being a pattern of sideways for about a year. In this case here, this was right before the quant unwind. This high lasted for a long time. And then you have this one here. This one lasted for well over a year. So I'm a little bit worried that at this point, with the leverage at these levels, the confidence at these levels, and the Sharpe ratio at here, seeing signs of contagion, that there's a risk here of an unwind to start, particularly as rates are going higher and people seem complacent that because the Fed kept rates on hold, it doesn't matter. There is a chance here that what the market decides is, it's great that the Fed did that. We view that as a mistake. And more importantly, that the thing I wrote about at the end of last year, this is a world of speed chess. And I think you have to make changes to your portfolio and assume that each quarter is what a calendar year used to be. And right now it looks like we're at a period of time where we're due for some sort of profit taking or deleveraging. This just shows that the reason you should watch the IG spreads, historically, this is the HFRX, the Global Hedge Fund Index, and then the white line inverted is CDX. So when CDX starts to become a place that people look to get hedges on, you start to see hedge funds lose money. So I'm expecting that to be the place for people to watch. Any spread widening to me is going to become more of an issue. Just 2 charts that I wanted to make sure people saw because I get asked about it in terms of the extension. I believe the dollar will continue to weaken. One of the reasons, or one of the primary reasons regarding what the Fed is doing, is I believe the world is going to at some point shift to something which is about inflation fighting. This is real 2-year yields relative to the dollar index, and this is going back to 2010. Obviously, the dollar is weakening, and we have real 2-year yields using 2-year break-evens and 2-year yields at minus 250 basis points, way below anything we've seen. And if we're right, what we were told yesterday is that the Fed is not going to move short rates. We have to believe them, which means if inflation does go higher and inflation expectations go higher, you're going to see this come down further. And despite the fact that the dollar's had a small bounce here, I think in my mind, there will certainly be a time where the inflation side will become an important part of the dollar rather than focus on yield differential on the long end. And then finally, just to put in perspective, this is NDX over the S&P, which is very similar to growth over value. I fully expect this to be a trend that lasts for at least the next couple years, if not more, because I do believe, as I have, that the inflation side will still stay in check this year. You will still have cyclicals over defense. The reason for that, and the reason that I think the dollar will end up being a problem at some point, is I really don't know how the Fed can make long-term yields come down. I also don't think they're going to bring short rates up very high. So the only thing really at their arsenal at some point is to discuss yield curve controls or Operation Twist. All of those to me would be bad for the dollar, but I think we're ways away from that based on what the Fed said yesterday. So that's it. It's an update. Happy to talk to people, but I think over the course of the next 3 months, there's a risk that the data is stronger than what we expect and that we're being a little bit too complacent of what higher yields is going to mean for the market. If it does spread and there is contagion, it's already showing in the equity market. I think the next place for it, or the last place for it to be important, where the transmission mechanism would be inside the credit spreads. So watch credit spreads, pay attention to see if they start widening, and in particular, keep your eye on rate volatility. That's it for me today. I'll speak to anyone in the coming weeks that wants to talk more about it. Thanks.
That concludes today's webinar. Thanks for watching.